Well, one of the other big stories that we're tracking for you here this morning, investors anxiously awaiting for the Fed's policy meeting. That kicks off today, two-day meeting, of course. The central bank faces a pivotal decision for another big interest rate hike or whether it's time just to hit pause or take a time out. Let's welcome in JPMorgan Asset Management Global Market Strategist Meera Pandit to discuss. Meera, great to have you here with us and get some of your insights. What do they do from your perspective here?
Right now, the market is pricing in about an 80% chance that they do go another 25 basis points. That's potentially reasonable at this standpoint because we are still fighting inflation. We do believe that inflation is going to come down. It will take some time, probably longer than the Fed wants. But the Fed does have to weave this line between not wanting to seem panicked, wanting to maintain credibility. Maybe if they pause entirely, that might send some jitters through the markets to show that they're still worried about the situation at hand. But they really have to balance out this inflation fighting with financial stability. We would say that, look, financial stability is a lot more important at this point. When something breaks, you have to consider breaking, even if inflation is elevated, because it is on the way down. And there's a lot of evidence that supports the Fed should start winding down its Fed hiking cycle, whether it's the fact that 70% of the gains in CPI last month came from shelter, which we know is lagging. Without it, it would have increased about 0.2%. In the jobs report, when we think about wages, wage growth has rolled over again, about 0.2% increase on a monthly basis. When we look at consumer expectations of inflation, that dropped in the New York Fed's survey of consumer expectations to the lowest since May 2021. And then you fold in some of the banking instability, and we've seen financial conditions really tighten pretty dramatically over the last couple of days. So irrespective and including some of the challenges with the banking system, it probably makes sense for the Fed to get closer and closer towards a pause.
Let's talk about the backdrop in terms of sentiment while all this is going on. Your peers over at Bank of America out with their monthly fund manager survey. Sentiment is pretty bad. If you look at the fund manager survey, investors' perceptions of risks, it worsened this month. Pessimism is close to where we typically see market bottoms, although they say some of their other indicators don't necessarily show a bottom right now. But what are you seeing in the indicators in terms of where the market is going to be tracking from here?
It's difficult to read the tea leaves right now because on the one hand, you do see that sentiment is very poor. And on the other hand, you see an S&P that is up for the year, considering everything that has happened so far and has been remarkably resilient. So investors are really holding on to some of those gains right now until we have further information. And what's so interesting is that usually markets do not like uncertainty. And in this case, markets seem to be taking uncertainty with a great degree of stride. Now, that's not necessarily the case in the rates market, where we've seen the most volatility since the financial crisis. So it's playing out more on the interest rate side as we try to peg exactly what the Fed is going to do. But within the equity market, you wouldn't necessarily know that investors are as pessimistic as they are right now.
Do you believe that we've bottomed out? I mean, the markets typically see that bottom prior to either a recession being entered or even the worst elements of that really being experienced. But again, the markets are trying to price this out well in advance of time. So have we already seen bottom, or do you believe that there's further declines to come still?
There could be some further declines to come from where we are today, but where we are today is actually reasonably far from where we were back in the fall. So I think that bottom is potentially in when we think about all of the things that we have been considering over the last year in terms of recession and how far the Fed goes. We're kind of getting to the point where we're realizing a lot of those realities, and there are surprises along the way. There's certainly challenges that we've seen over the last 2 weeks. But I do think that probably the market low is in there, but it doesn't mean we can't move a little bit lower from where we are today, which seems a little bit unsustainably high, because you also have to fold in, it's not just a Fed story, it's an earnings story as well. We've seen profit growth weaken. So I think that thread has been lost over the last 2 or 3 weeks as well, in that profits are still weakening, and that's going to put pressure on stocks as well.
Here's another disconnect in the market. You mentioned, of course, that stocks are up this year despite all of the sentiment. What's led them? Tech, which is also sort of counterintuitive, right? So the XLK, which we're showing right now, is up some, what is it on the year? Something like more than 10% here. So what gives? Is that something that is now vulnerable, even if the Fed is going to pause?
we have to be a little bit careful around tech stocks and really ground ourselves in valuations. Where do we actually see reasonable valuations? Where do we see a reasonable trajectory of profits? Look, to be fair, tech companies, especially mega cap tech, have gone through a year of reckoning in terms of what they can actually do from a profitability standpoint. Many of them are making prudent decisions as it comes to scaling back in certain places. We are getting closer to a Fed pause and probably at a lower rate than maybe we would have thought even 3 weeks ago. And you have seen, again, some of that valuation bubble come out of the system. So I think those are important points to consider. And look, people really look for some of the more defensive areas in times of stress. And tech has become a much more defensive area over the years when you think about some of these higher quality, essentially blue chip companies at this point. But again, we really want to, above all, in any asset class, ground ourselves in valuations where we think the prices are still fair. Where they're not is where we're vulnerable to correction.
One of the major themes that we had heard about starting out 2023 was healthcare. Does that theme still hold up even right now? I mean, the sector's been doing decent over the past kind of 1 week as we had seen some sputtering more broadly here. But even further as we get out into 2023, does that theme still hold as a strong play for people's portfolios?
It's somewhat mixed. Look, I think in the short term, it benefits from being a bit more defensive in nature. In the very long term, it benefits from having access to some of those longer term secular growth themes. But what we are hearing from a lot of companies is that they're still in this rock and a hard place between COVID is over, so we have less of a tailwind from some of those specific areas of medical care. And yet a lot of the elective surgeries have not quite picked back up. There's still a lot of staffing issues. So I think that some of the transitional pains are being experienced in the healthcare sector that might pose a challenge in the short run.
All right, Meera, good to see you. Thanks for coming into the studio. We always appreciate that. Meera Pandit of JPMorgan Asset Management. She's a global market strategist there.